Okay, let's talk about a huge shift happening in the world of finance. I mean, a really fundamental one. One where a meteorologist's forecast is suddenly becoming just as critical as an economist's. We're diving into how climate change is being hardwired into the most basic banking decision: who gets a loan and what it's going to cost them.
I know, it sounds a little over the top, right? Could a heat wave or a wildfire or a flood literally stop you from getting a mortgage on a new house? Or a loan to start a business? Well, the answer, and this is happening right now, is yes. This isn't some far-off sci-fi plot, it's the new reality of credit risk. For the longest time, we've kind of siloed climate change as an environmental issue, something separate from the economy. But that's all changing. The global financial system is waking up, fast, to a new truth. Climate change is a direct and growing threat to financial stability. It's a risk, a financial risk, and banks are now scrambling to figure out what that even means.
So here's how we're going to break it all down. First, we'll get into why your bank suddenly cares so much about climate change. Then we'll unpack the two main flavors of risk they're worried about: physical and transition. After that, we'll trace the chain reaction, how a storm can lead to a default. We'll peek into the hood at how they're trying to model this stuff, and finally we'll look at the massive challenges ahead on this new frontier of finance. All right, first up, let's just nail down this main idea. This is not a niche concern anymore. We're talking central banks, global regulators, the biggest financial players. They're all treating climate change as a core driver of good old-fashioned financial risk.
And this number, right here, this is why. We're not debating some far-off problem. The data is clear. Our world is already at least 1.1 degrees Celsius warmer. This isn't a forecast, it's the world we're living in today, and it's what's forcing the entire financial industry to play catch-up.
You know, this hasn't just happened overnight. You can see on this timeline that the momentum has been building for years. It started with major groups trying to define the problem back in 2015 and 2017, and now it's leading to concrete action plans with real deadlines. The pressure is on.
So, to really wrap your head around how climate impacts money, you've got to meet the two main characters in this story: physical risk and transition risk.
So what's the difference? Well, physical risk is exactly what it sounds like. It's the brute force of nature, the direct damage from things like hurricanes, wildfires, floods, the acute stuff. But it's also the slow burn disasters, the chronic shifts like rising sea levels. Transition risk, on the other hand, is all about us. It's the financial risk that comes from how we react to climate change. Think new government policies, new green technologies, or just people deciding they don't want to buy certain products anymore.
And these two images really nail it. On one side, you have the direct physical impact: a city literally underwater. On the other, you have our response, building a whole new energy system. Both of these forces, the natural and the human, are creating huge financial winners and losers as we speak.
Okay, so we've got these two powerful forces. Now for the really important part. How exactly does a storm in one part of the world cause a loan to go bad on a bank spreadsheet? How does a flood actually sink a loan?
Well, it all comes down to this one simple concept: credit risk. It's just the fancy term for the chance that someone, a person or a company, won't be able to pay back their loan. Every single time a bank lends money, it's making a bet on that borrower's financial health. And to do that health checkup, lenders are basically looking at three things. First, cash flows. Can you actually bring in enough money to pay your bills? Second, capital. What kind of financial cushion do you have? And third, collateral. If everything goes wrong, what assets can the bank take to get its money back? And right here, this is where it all clicks into place. This table shows exactly how climate change attacks a company's financial health. Let's look at that top row, cash flows. A transition risk, like a new carbon tax, could totally crush demand for your product. A physical risk, like a drought, could shut down your supply chain. Now look at the second row, capital and collateral. A transition risk could make your oil reserves worthless, a stranded asset. And a physical risk, well, it could just burn down the factory used as collateral.
So, the banks know this is happening. The next massive challenge, and this is the really tricky part, is figuring out how to measure it. How do you actually predict the financial damage? This is the quest to build new models for a much warmer world.
A kind of three-step playbook is starting to take shape across the industry. First, you have to imagine different climate futures. These are your scenarios. Second, you try to estimate how each scenario would impact a specific company's bottom line. And third, and this is the whole point, you translate all of that into the language of credit risk. That means changing things like the probability of default, or PD, basically the odds a company will go bust, and the loss given default, or LGD, how much money the bank loses if it does. But
And this is a huge but. We need to be crystal clear. This is not a perfect science, far from it. As the source material points out, these tools are really in their infancy. It's a field that still relies a ton on guesswork and expert judgment, mostly because we're trying to model something that's never happened before.
So here's one classic model they're trying to adapt. The idea is simple. A company defaults when its debts are worth more than its assets. Now, look at the chart. Imagine new climate costs hit, like having to upgrade all your equipment. That lowers the value of your assets, shifting that whole blue curve down. And that makes it way more likely to cross below the red line of your debt, which means default.
So after all that complex modeling, all those scenarios, all those calculations, the bottom line is this. It all boils down to changing those two key numbers for every single borrower. A higher probability of default means a company's in more danger. A higher loss given default means the bank's in more danger if things go south. And climate change is pushing both of those numbers up.
Okay, on to our final section. Now, if all this sounds incredibly hard to do, well, that's because it is. We are genuinely at a new frontier for how we think about risk, and the challenges are, frankly, immense. Here are some of the biggest headaches. First, you can't just look at the past anymore. Historical data on storms and heat waves doesn't tell you much about the future. Second, these risks play out over decades, but a normal credit model only looks out about a year or two. Third, you need amazingly specific data. It's not enough to know a company is in manufacturing. You need to know the exact flood risk of its specific factory in Vietnam. And finally, you have the huge translation problem. How do you turn a 2-degree temperature rise into a specific number for a company's cash flow?
Which really brings us to this one final, powerful question. As we get better and better at modeling all this, what we're really doing is uncovering a hidden cost that's baked into almost everything. A cost for having a business on a coastline, a cost for relying on fossil fuels, a cost for not being ready for the green transition. The work happening right now is the very first step toward making that climate cost visible on every balance sheet. And maybe, just maybe, one day on every single price tag.